Welcome back to Risk to Reward. In this video, we're breaking down Nebius Group, starting with what the company actually does, before moving into the positives and negatives of investing in the stock, and finishing with a balanced investor takeaway. Nebius is an Amsterdam-based AI infrastructure and cloud computing company focused on providing high-performance GPU capacity for enterprise and hyperscale customers. Its core business is supplying the compute power required to train and run large artificial intelligence models, positioning Nebius as infrastructure rather than application software. Visually, what you're seeing here are large-scale data centers and GPU clusters, because Nebius sits underneath the AI boom, providing the hardware and cloud capacity that major technology companies depend on. What truly sets Nebius apart is the scale of its recent contracts. In 2025, the company signed a 5-year AI infrastructure agreement with Microsoft valued at approximately $17.4 billion, with disclosed options that could increase the total value to around $19.4 billion. Nebius also signed a separate 5-year agreement with Meta worth roughly $3 billion to support Meta's AI workloads. These deals place Nebius directly in the backbone of the global AI ecosystem, acting as a picks and shovels provider rather than competing with AI developers themselves. As the visuals shift to the investment case, the positives become clear. The size and duration of these contracts provide rare long-term revenue visibility for a relatively young infrastructure company. And this momentum is already reflected in the numbers, with Nebius reporting third-quarter revenue of approximately $146 million, representing growth of more than 350% year-on-year. This rapid growth and contract visibility have driven strong market interest, with the stock rising several hundred% over the past year as investors price in sustained AI infrastructure demand. However, as the visuals turn more cautious, the risks are just as important to understand. Nebius remains loss-making, with net losses widening as the company aggressively expands data center capacity, power infrastructure, and GPU deployments. Capital expenditure has surged sharply, with quarterly spending approaching $1 billion during peak build-out phases, meaning cash burn remains high and funding requirements are substantial. There is also meaningful customer concentration risk, as a large portion of future revenue depends on a small number of hyperscale clients, making execution and long-term contract performance critical. As we move into the final comparison visuals, the full picture comes into focus. Nebius has secured some of the largest AI infrastructure contracts in the market, with multi-year agreements exceeding $20 billion in combined value across Microsoft and Meta. But this growth comes at a very high cost. Heavy capital expenditure, ongoing losses, and operational complexity mean Nebius is not yet a stable cash-generating business. Instead, it represents a high-risk, high-reward investment that depends on sustained AI demand, disciplined cost control, continued access to capital, and flawless execution at scale. In short, Nebius offers substantial upside if it successfully converts infrastructure scale into durable profits and operating leverage, but investors must be comfortable with volatility, funding needs, and long-term uncertainty along the way.